Hi, my name is Mike Kolodner. I'm the Managing Director and leader of Marsh's U.S. Power and Renewable Energy practice. I'm going to be talking today about mature risk strategies for a maturing industry and mitigating the adverse impact of catastrophic risk underwriting to accelerate PV solar development. Before we begin, a little bit about Marsh, for those that may not be familiar with us. Marsh is a member of the Marsh & McLennan family of companies, the global leader in risk, strategy, and people. We have a 150-year history of leadership and innovation in insurance brokerage and risk advisory. And indeed, we have the largest global renewable energy brokerage and advisory team with the most diversified client base. We serve not only developers, but owners, operators, investors, original equipment manufacturers, and the really all of the stakeholders in the space. So let's put a little context around the cost of insurance. We're here today talking about the cost of insurance for solar projects, and the reality is that many developers are finding that their historical assumptions for the cost of insurance and the types of coverage that may be available are now really challenging their models. But it's important to understand that it's not just happening in a vacuum. That generally speaking, if you're a buyer of insurance these days, you are finding it more difficult to buy insurance than perhaps it was last year or the year before. It's more expensive. The market is more disciplined in how they price risk. So we're in the middle of what we would call a hard or firming marketplace, where essentially we're no longer in a buyer's market. The index that I've shared here is Marsh's quarterly index. So we're looking at changes experienced by buyers of insurance. These are annual contracts. So increases experienced by individual buyers in each quarter across all industry classes. Within the renewable space, the increases that we're seeing generally are running at or above these levels, and in the solar space in particular, can be considerably more, particularly if projects are exposed to catastrophic risk, something which historically was not necessarily priced into the cost of insurance. And you can see the quote from G-Cube. There's a number of predominant underwriter in the space. There's a number of factors that go into the cost of insurance, and if historically competition and the emerging nature of the marketplace for insurance products to service the industry factored into underpricing, the awareness of catastrophic risk and the maturing of the underwriting is leading to increases which could be considerably higher. And indeed, some are certainly experiencing higher than average increases. In some cases, triple digits compared to what they might have otherwise expected just a year or two ago. So let's talk a little bit about the specific cost of insurance for photovoltaics. What you're looking at here is an index of Marsh projects and portfolios. Gives you some sense of what to expect with respect to cost, something we use to help our clients appreciate as they're going into a project or evaluating it, what it might reasonably cost. It's using our actual proprietary placement database. And the three projects that we've highlighted here are ones that all have one thing in common, and that's they're located in high hail regions of Texas. So you can see the delta off of the average. This is a relatively new experience for many in the development community. Recognition that hail as a catastrophic risk is something that needs to be considered is relatively new. This was not part of the dialogue for most developers as recently as a year and a half or 2 years ago. But it certainly is today, following substantive loss activity and a recognition in the underwriting community that this exposure is real and that it needs to be priced effectively. So what is it about catastrophic risk that presents such a challenge to underwriters? What is it that's driving the magnitude of differentiation now that we're starting to look at pricing hail into the cost of insurance for these projects? A couple things to note here. One, we're talking about low frequency, high severity events, so we don't have a lot of data points to inform actuarial analysis. We don't have high confidence in what the actual cost will be. We just know that the experience in the short term versus what we'll experience over the long term are two very different things. If we think of those three projects on the previous slide, we don't expect any one of them to suffer a high severity hail loss next year or the year after, but we also know that it's quite possible that they could. And that variability in the expected outcome drives a considerable average annual loss number, and you can see the number in the model on the right, the output here. That's the difference between having hail as an exposure and not having it. There's only so many projects that exist, and to come up with a technical rate for exposures is relatively challenging. And as you add catastrophic risk exposures in, you can see that it's a unique peril that brings with it a considerable cost. Also, the severity challenge here is one that I think also is worth pointing out. Independent of what an underwriter might want to charge for that risk, they also have to think about whether they can be exposed to it at all, whether they can sustain a loss of that magnitude. So really a challenge, and ultimately projects today are seeing that in addition to the cost increases, they're simply not able to get the coverage that they might have been able to get for projects in similar locations or of a similar size just 2 years ago. So what can we as an industry do? If ultimately what we're talking about here is that underwriters are pricing with greater discipline, that is ultimately driving a higher cost to risk finance, in some cases changing the dynamics around what is even possible to insure. What can we as a community do to really improve the ability for us to finance these projects? We're not going to stop developing them, so how do we do it with greater confidence and at lower cost and with less volatility? The first thing we can do is think about the location. It really is critical. We can't avoid locations which have catastrophic risk exposure, but we can learn more about them. We can be more thoughtful about those locations. We can assess the risks more completely, and we can communicate on them. To the extent we can share information around how we arrive at our decisions, how we think about the exposures, how we measure them, that all is tremendously helpful. So if I think about it from how we're working with clients today, first and foremost, looking at that location and much earlier on in the development process, really assessing the risks inherent with each individual location. For some, you may be able to choose an alternative location with a different risk profile. For others, it may simply be making sure that we enter into the process with a fuller appreciation for the risks that are going to have to be managed. Second, materials and systems really do matter. When we talk about risk management, we're not just talking about buying insurance. If we can make decisions around improving the resiliency of the projects that we're building, the benefits are truly significant. And this is not something that is unique to the solar community by any stretch. Industries have all experienced this. Ultimately, as industries mature and investments are made to prevent losses from happening in the first place or to improve the resiliency of individual assets that are exposed to loss over time, as we build better, we ultimately see that the cost of risk goes down. From an underwriting perspective, it will become easier for underwriters to insure and finance risk with greater confidence and consistency um, as the industry matures. And for those that are struggling on looking at cost benefit, there are methods that are out there to look at the cost of risk reduction, how to value access to expanded supply so that you can maybe make some better informed decisions on the front end as well. These are costs which play out over the life of a project, but you only get to make those decisions on materials and systems in the beginning once. Finally, challenging perceptions of what's possible. Modeling exposures is not new to the solar community, but higher quality modeling informed by professionals that have the experience and the expertise to not simply enter latitude and longitude points into a model, but to really appreciate how site selection, materials, systems, and design can affect outcomes is important. And the other thing that's important is creating opportunities for new risk capital to participate, new partnerships, um, uh, information that enables us to create new markets. And ultimately, one of the best signs that we're seeing these days is that mutual partnerships are essentially insurance owned by the insured, insurance companies owned by those who pay the premiums, are starting to emerge with a number of mutuals joining the space. In addition to new commercial capacity, which is great. We need a more diverse, we need a more robust um, source of supply, and the more markets we can bring to the table, the better off we're all going to be. So what we're really talking about then is improving the maturity with respect to risk management in the solar community. Um, Risk management for really too long in this space essentially was equated with buying insurance. If buying insurance allowed us to efficiently access third-party capital to finance these projects to get them built, well, then that was really the most efficient path and the best way forward. We're no longer able to do things that way, and we're not able to do it because we've got insurance markets that are more attuned to the risks that they're actually assuming. They're more aware of the catastrophic risk in particular, but also, frankly, there's more competition. There's more players. It's far more difficult, and the world's changed, and the cost of insurance has gone up independent of what we may have experienced here. So, maturity with respect to risk is really something that really does matter. The exhibit on the right takes that same benchmarking analysis that we provided previously and just gives you some perspective on the impact that risk management maturity can have on the cost or the value of an individual 150 megawatt project. Material differences between first and fourth quartile with respect to the cost of insurance over a 15-year or 20-year life cycle. You can see that ultimately, if we take the time to think about it and finance projects as efficiently as possible, those that do it better save real dollars, and those dollars can be used to offset the cost of resiliency. This is important to consider because ultimately flight to quality is already happening. When we think about solar risk from an underwriter's perspective, they are in competition for the highest quality risks. They are aggregating projects, and their experience underwriting those portfolios influences how they charge going forward. And those that can differentiate themselves will find that they have access to more sources of capacity over time. They will find that there's greater competition for their projects. And the converse is also worth noting, which is that those projects that fail to demonstrate improved levels of risk management maturity may find themselves short on capacity or paying certainly fourth quartile rates. So their project valuations may suffer. This is an important thing for all of us to be aware of, because the improving of risk management maturity across the space is a rising tide which can really improve the economics for the industry as a whole. I'm just going to finish briefly. I'm going to highlight that there are a number of resources included in this presentation. If you'd like to learn more about some of these concepts, more than happy to do it. And the links that have been provided to some of our thought leadership or content on this are available for you to peruse. Thanks so much for your time. Very much appreciate it.